Welcome to the Deep Dive. Today we're jumping into Morgan Housel's book, The Psychology of Money.
Yeah, it's a really insightful book.
And if you're listening, you probably want to get to the heart of important topics like money pretty efficiently.
Exactly. And our plan today isn't to rehash standard financial advice. We want to uh, really unpack the core behavioral stuff Hels talks about.
Right, the psychology behind it all.
It's less about rules and formulas, more about understanding why we do what we do with money.
Because the book's big idea, and it really hits home, is that doing well with money isn't mostly about how smart you are. It's about how you behave.
He gives that great example, doesn't he?
Yeah.
The wealthy executive who just lost it all.
Yeah, tons of money, but poor behavior. It shows that how you act is, well, maybe everything.
So let's dig into that. The difference between knowing what to do and actually, doing it.
Yeah, the doing part is tough. Housel says it's hard to teach, even to really smart people.
And he draws this interesting contrast, like health relies a lot on science, things we can measure and predict, to some extent.
But money. Oh, money's often driven by psychology, emotions. It can seem totally irrational sometimes.
Totally. And because of that, everyone's view of money is unique. It's shaped by your personal background, your experiences.
Like someone who grew up poor versus the child of a wealthy banker, they'll see risk completely differently.
Or someone who lived through massive inflation versus someone who only saw stable prices. Their instincts about saving or spending will be miles apart.
So financial advice can't really be universal then.
That's the point. And there's research backing this up. Economists Malmedier and Nagel found your willingness to take risks often depends more on your personal history.
Like when and where you were born, just luck.
Pretty much. Not just how smart you are or what you studied. Even Bill Gross admitted his huge success partly came down to being an investor during a massive, decades-long drop in interest rates. Timing.
Wow, that really makes you think. And it explains some things, maybe, like why lower-income folks might buy lottery tickets more often.
Housel suggests it might not be irrational to them. If other paths seem blocked, maybe buying that ticket feels like buying a tiny piece of hope, a dream.
So every decision kind of makes sense to the person making it in their own context.
Exactly, based on their story. Which leads to another big idea, luck and risk.
Ah, yes, the inseparable twins.
Right. These forces are always there, influencing outcomes way beyond our own effort. Housel mentions Bill Gates, hugely successful.
But there is also Kent Evans, apparently just as talented, same school, same early interest in computers, but he didn't have the same luck.
It means when we look at financial success, ours or others, it's probably never quite as good or as bad as it seems on the surface.
Because luck and risk are messing with the results.
Yeah, and it makes it super hard to tell if a bad outcome was because of a genuinely bad decision or just bad luck hitting a decent decision.
And we tend to judge others harshly, right? Their failures are bad decisions.
But our failures, ooh, that was bad luck, unforeseen circumstances.
Housel uses Jesse Livermore and Abraham Jermansky as examples here, both brilliant at making money.
But terrible at keeping it. They both crashed and burned.
Which underlines a crucial point. Just surviving, staying in the game long enough, that's maybe the most important financial skill.
Which ties perfectly into the idea of enough.
Oh, I love that anecdote he shares. Kurt Vonnegut and Joseph Heller at some billionaire's party.
Yeah. Heller points out that he has something the billionaire might never get.
Enough. Just knowing when you have enough.
It's powerful. And then you contrast that with someone like Rajat Gupta, incredible success, top of his field.
But wanted more. So much more that he ended up committing insider trading.
It's that Warren Buffett quote, isn't it?
Yeah.
Risking what you have and need for something you don't have and don't need.
Yeah.
It's just foolish.
And this whole social comparison thing, trying to keep up. It's a game you can't win. The ceiling just keeps getting higher.
The only way to win is to kind of opt out, to decide your own enough. Otherwise, that hunger for more can lead to real trouble, real regret.
Okay, so if enough is about contentment, what about actually growing wealth? Heisel talks a lot about compounding.
Right, the magic of time. He uses the analogy of ice ages. They don't happen because of one massive snowfall.
It's the snow that lasts year after year, even small amounts building up, that quote from the glaciologist.
It is not necessarily the amount of snow, but the fact that snow, however little, lasts. That's compounding. Small gains building on themselves, leading to huge results over long periods.
And that's his point about Warren Buffett, right? His fortune isn't just because he got amazing returns year after year.
Not solely, no. It's because he's been a pretty good investor for an incredibly long time. since he was a kid.
Compare that to Jim Simons at Renaissance Technologies. Much higher average returns than Buffett.
Phenomenal returns.
Yeah.
But he started later. So even with better performance, the shorter time frame means less overall wealth accumulation compared to Buffett. It shows how powerful that time element is.
We tend to think in straight lines, but compounding is exponential. We underestimate it.
Hugely. Which brings us back to those stories, Livermore and Germansky. Getting money and keeping money.
Different skills entirely.
Totally different. Michael Moritz from Sequoia Capital had that great line about their success.
The paranoia.
Yeah, basically, only the paranoid survive. They were always afraid of going bust, because compounding needs decades to work its magic, like planting oak trees, not weeds.
You have to survive the storms, the inevitable downturns.
Which is where that idea of margin of safety comes in. It's not just being conservative.
It's building resilience, a buffer.
Exactly. It means you can handle a range of outcomes, not just the one you hoped for. It lets you endure the bad times so you can stick around for the good times. It increases your odds of staying in the game long enough for compounding to work.
So having that cushion, whether it's savings or just flexibility in your plan, is crucial.
It's maybe one of the most underappreciated forces in finance. It lets you sleep at night, even when markets are crazy.
Okay, so we need to survive. But Housel also talks about how we react to events, especially extremes. Failure can be a bad teacher sometimes.
Yeah, if it makes you think a perfectly reasonable decision was terrible just because you hit some bad luck, some risk you couldn't foresee.
Like getting scared out of the market after one crash, even if your long-term plan was sound.
Right. And you see people chase extremes too, like everyone wants to be a billionaire, maybe.
But the risks you might take to get there could wipe you out completely.
It connects to the idea of tail events. Housel explains that in many fields, like venture capital or even the broad stock market, a tiny number of events or investments drive the vast majority of the results.
Like, most stocks don't do much, but a few massive winners pull the average way up. He mentioned the Russell 3000 index statistic.
Exactly. A small percentage of companies account for almost all the gains. So as an investor, your long-term results often hinge on how you behave during those few crazy periods, the tails.
And you don't have to be right all the time. Peter Lynch said even great investors are maybe right 6 out of 10 times.
Being wrong is normal. Jeff Bezos talked about failures at Amazon. They expect them. But the few huge successes pay for all the misses, many times over.
It's like that George Soros quote.
It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. Focus on the magnitude.
Makes sense. Okay, shifting gears slightly. Beyond just the numbers, Housel talks about what wealth is really for.
And he argues the highest dividend money pays isn't more stuff, it's control.
Control over your time.
Exactly. He cites research by Angus Campbell, a psychologist, who found that having a strong sense of controlling your life is a more dependable predictor of happiness than your salary or how prestigious your job is.
That really resonates, the feeling of autonomy. I remember reading about the author quitting investment banking, a huge pay cut, but gaining control over his days. That was worth more.
Yeah, it's a powerful idea. And you look at broader trends, like in the U.S. since the 50s, people are generally wealthier.
But are they happier? Not necessarily.
Housel suggests maybe we've traded control over our time for more income, more stuff. We work different jobs now, too. John D. Rockefeller apparently spent a lot of time just thinking.
Yeah, less physical labor, more knowledge work.
But the downside is that work feels like it never ends. Your brain is always on. Derek Thompson called the modern factory the day itself.
Oh, yeah. Okay, another psychological quirk. Signaling wealth. Why do people want fancy things?
Often, Housel says, it's because they want to signal to others. Admire me, like me.
But the irony is,
Other people don't usually admire the person in the fancy car. They admire the car and use it as a benchmark for their own desires.
right. I remember reading his story about being a valet. He rarely thought about the driver, just the cool car.
So the signal doesn't quite work as intended. What actually earns respect, he argues, is humility, kindness, empathy, not horsepower.
And true wealth, he defines it as what you don't see.
Yes, the asset's not spent, the car's not bought, the diamond's not worn. Wealth is hidden. That's why it's hard to learn about it by looking around. We only see the spending.
Until someone passes away, like that janitor Ronald Reed, and everyone's shocked to find out he was a multimillionaire through saving and investing.
Exactly, which leads nicely into the power of saving.
Simple but critical. Housel says building wealth often has less to do with your income or even your investment returns.
And more to do with your savings rate. how much you keep versus how much you make.
He uses the 1970s oil crisis as an analogy. Part of the solution wasn't just finding more oil, it was becoming more energy efficient, using less.
It's about controlling the outflow. Because wealth is relative. It's about having enough to meet your needs and desires, not just hitting the highest possible return percentage.
And that links to being reasonable versus strictly rational with investments.
Yeah, sometimes the mathematically optimal strategy isn't the best one for you because you won't be able to stick with it emotionally.
Like maybe putting everything in stocks has the highest expected return on paper.
But if you can't sleep at night during a downturn and end up selling at the bottom, that rational strategy becomes disastrously unreasonable for you. Minimizing future regret is key.
So maybe splitting 50-50 between stocks and bonds isn't technically optimal, but it helps you stay the course. That's reasonable.
Or just avoiding strategies that feel too complex or scary, like using lots of leverage, even if they promise higher returns. Passion matters too. Being interested in what you own helps you stick with it.
Even things like home bias, favoring investments from your own country, might not be perfectly rational, but maybe it feels more comfortable, more reasonable.
Right. And we have to be careful about relying too much on the past. The historians as prophets fallacy.
Assuming the future will look just like the past.
But the world changes. Benjamin Graham, the father of value investing, apparently kept tweaking his formulas because market conditions evolved. John Templeton's famous line.
The four most dangerous words in investing are, "This time it's different."
But then Michael Batnick pointed out that it's never different. It can be dangerous too. Things do change. Innovation happens. Crises happen.
So you need humility and room for error.
Yes. Back to that margin of safety.
Yeah.
He uses a blackjack analogy, card counting.
Even if you have an edge, you can still hit a bad run of luck.
So you need enough capital, enough of a buffer, to withstand that bad luck and stay in the game. Kevin Lewis said you need at least 100 basic units. Room for error lets you survive the inevitable bumps.
And it's not just defensive. It lets you stick around long enough to potentially benefit from those rare, massive positive events, those tails we talked about.
But things like excessive leverage, they destroy your room for error. They turn normal market volatility into potential ruin.
Like we saw in the housing crisis or with Lehman Brothers.
Exactly. One way to think about managing this is the barbell strategy.
Being really safe with most of your money, but taking some calculated, potentially high-reward risks with a smaller portion.
Sort of balancing extreme safety with extreme risk, avoiding the mushy middle. But the core idea, always, is planning for things not to go according to plan.
Because life happens, and people change too, right? The end of history illusion.
Oh yeah, fascinating research. People consistently underestimate how much their own values, goals, and personalities will change in the future.
We tend to think our personal history is just sort of ended, that who we are now is who we'll be forever.
But it's an illusion, and it makes long-term financial planning really hard. You set these rigid goals for your 60-year-old self when you're 30.
But your 60-year-old self might want completely different things, and then you end up disrupting the plan.
So Housel advises avoiding the extreme ends of financial planning. Don't commit yourself to a path that leaves no room for your future self to change their mind. Aim for moderation to minimize future regret.
Okay, another really important concept, understanding the price of investing success.
And it's not just dollars and cents. The real price is dealing with volatility, fear, doubt, uncertainty, regret, all that emotional turmoil.
That's the cost of admission for getting potentially good long-term returns. You can't avoid it.
He uses the analogy of buying a car. You pay the sticker price, you get the car. Trying to get investment returns without accepting the volatility, that's like trying to steal the car.
You have to pay the price. And he shows data, like for Netflix or Monster Beverage, huge long-term winners.
But they spent most of their time trading significantly below their previous highs. Lots of painful drawdowns along the way. That's the price investors paid.
And trying to avoid paying that price, trying to smooth everything out perfectly, can lead to bad behavior too. Like GE under Jack Welch, maybe pushing too hard for smooth earnings.
Or the accounting games at Fannie Mae and Freddie Mac before the crisis, trying to hide the inherent messiness and volatility.
So the key is mindset. View that volatility not as a fine, like something you did wrong.
But is the fee, the cost of admission to potentially higher returns over time? Pay the fee willingly.
Let's talk about nubbles. They seem like such obvious mistakes in hindsight.
But Housel points out they're really hard to learn from, because people rarely agree on the causes or who was to blame afterwards.
And during a bubble, behavior that looks crazy long-term might actually seem kind of rational for short